Welcome everyone to today's webinar brought to you by Dodge Data and Analytics, the leading provider of data, analytics, news, and intelligence serving the North American construction industry. I'm your host, Burley Morton. As Senior Director, Research and Analytics at Dodge Data and Analytics, I lead a team of construction industry economists, industry analysts, and others here in Bedford, Massachusetts. Most of you probably know or have heard of Bob Murray, Dodge's chief economist. Bob sits in the office right next to mine here in Bedford. Bob recently presented Dodge's 2017 construction forecast at our Outlook Executive Conference held on October 20th at the Gaylord National Harbor Hotel in Maryland, just across the river from D.C. Richard Branch, senior economist for Dodge, also presented at this conference. Almost my entire career has been spent at Dodge with two interruptions. The first time was when I worked at Data Resources, Inc., or DRI, an economic forecasting firm acquired by McGraw-Hill in the early 80s. Working for DRI was great for me professionally and personally, since that's where I met my wonderful wife, who at the time was a DRI economist. And yes, 30 plus years later, we're still very happily married and best friends. My second departure from Dodge was about 10 years later when I worked at Standard & Poor's, also owned by McGraw-Hill. Over my many years at Dodge, I've worked directly with many building product manufacturers, contractors, and others like distributors and equipment rental firms to assist them in their never-ending goal to improve their go-to-market strategies. This includes their efforts to better manage their market opportunity for business success. Over the next 35 to 40 minutes, I will be walking you through what I view as the basics of how to measure your market opportunity for business success. At times, I'll be referencing Dodge data. However, this webinar is intended to be more of a primer on the process of appropriately using data to measure your market opportunity, whether it be from Dodge or from another source, such as the U.S. government, industry associations, etc. On your screen, you should see a place below the slide for you to type in a question. Please do so as they arise. At the end of my 35 to 40 minutes, I will do my best to reply to as many questions as possible. If you look at the asterisk, it says you can't manage what you don't measure. This is actually a quote from the pretty famous management consultant Peter Drucker. I'm sure you've heard it from others, and it's kind of a business axiom that one needs to measure in order to react and make appropriate decisions, because you can't manage what you don't measure. Whether you use your own salespeople, independent reps, or distributors to sell your products, you really do need to have a realistic understanding of your market opportunity in order to make more effective decisions about how to position your sales, marketing, and product resources. During this webinar, I'll discuss different ways you can measure your market opportunity, what data to use, and where to find that information. I'll have to admit that it kind of irks me even when we have our press release, because very often people just read the top line of the press release, which usually refers to total construction activity. And by just looking at total construction activity, it can be so very misleading. Just so, for example, if total construction is up 4% over last year, you may believe that that relates directly to the market opportunity that you're trying to measure for yourself. And that's not always the best way to look at trying to measure your market opportunity. It can be very misleading. At a minimum, you should be looking at the three broad categories of non-residential, residential, and non-building construction activity. If you were to do that, you would very likely to see that the percent change year to year by those three broad categories are not going to be consistent with the percent change that you see for total construction. In the example that I give here, we've got non-residential going up 16%, residential dropping by 10%, non-building being flat, and when you sum them all up together, total construction is plus 4%. But if you sell a service or a product that goes mostly into non-residential, by looking at that total construction of plus 4%, it can be very misleading in terms of gauging your market opportunity. So what you really need to do is you need to dig deep into the data to do a better job of measuring your market opportunity. And for example, one really needs to look even beyond the three broad categories. So you're looking at within non-residential, which consists of commercial construction activity like hotels and motels, offices, and stores, institutional construction, which would include hospital and healthcare projects, government service buildings, religious buildings, education buildings, and then also manufacturing, which is a part of non-residential. You need to actually drill down to that level because for sure the amount of market opportunity that is created for you, depending upon the product or service that you're selling, is going to be affected more strongly by some categories or sectors versus others. So if, for example, you're selling information into, and I'm just going to pick a category, if you look at single family versus multifamily, by drilling down to the sector level, you will see that each sector does not necessarily move in sync with the other sector. As an example, I'm looking at activity for the percent change in construction starts as recorded by Dodge for multifamily versus single family in 2014, 15, and 16. For multifamily in 2014, it was up 33%. It had another good year in 2015, being up 22%. If you look at single family, still within the broader category of residential, it's a different story. In 2014, single family was only up 3% versus the 33% for multifamily. And although it had double-digit growth on a value basis of 14% in 2015, not as high as multifamily, which came in at 22%. Additionally, the change in total U.S. construction activity is never a reflection of what's happening in a specific region, state, or local market. Therefore, it's important that you break down construction activity by geography. Let's take the office building construction as an example. So from 2010 to 2015, the U.S. construction office sector grew at an average of nearly 40%. That doesn't sound too bad, does it? However, now if you look more closely at the growth for the top 3 states, for office starts, you see that the rate varied significantly from the national average. California roughly grew by 125%, New York slightly above 25%, and Texas exceeded 200%. As you can see, these are significant variations which you would want to know if you were targeting any of these states in measuring the opportunity, the market opportunity that you were pursuing. Now you need to gauge performance. Understanding geographical activity enables you to gauge the absolute and comparative size of your market opportunity. Given that you have this geographic data, how can you use it to objectively assess performance and set sales goals, for example? So, for example, if you had Territory A, it has twice as much sales activity as Territory B. Does that really mean that Territory A is performing better? Not necessarily if Territory A's market opportunity is 3 times greater than Territory B. Then the truth is that Territory A is not performing as well against its market opportunity. So now we're looking at the average office starts for the period 2011 and through 2015. So we're looking at the absolute size geographically. So you can see that California, right, a huge state, comes in at 2.16 billion, but relative to New York, which over that time period accounted for 17%, a whopping 17% of national office construction starts, the value is almost twice what it was for California. And what's also interesting is that the relatively small state of Massachusetts, where I reside, was in fact a pretty healthy market for office starts relative to California, New York, and Texas, which are much, much larger states. You also need to look at construction activity in context. And by that, I mean that you need to look at the historical perspective of what's happening with your market opportunity so that you can better interpret expected change, be it positive or negative. So, for example, knowing today's temperature is 10 degrees higher than yesterday is only valuable if you have it in context. When yesterday's temperature is 60 degrees or 80, was yesterday's temperature 60 degrees or 80 degrees? And was that considered low, high, or average? The same need for context holds true for understanding next year's expected construction activity and what that means for your business in terms of market opportunity. Next year's expected construction activity is only meaningful if you know how it compares to prior year's activity. Let me explain further. Now here's a chart that looks at single-family housing starts in units over time. And I like to use this as an example of putting current activity or expected future activity in context using a time series. I remember actually talking to a client back in 2013 about what we expected for single-family construction. And we had a very, very healthy forecast for single-family construction. And he was actually questioning my sanity, and especially since we had seen a significant growth the prior year. The reality is, if you put those back-to-back significant growth rates for single-family in perspective, you'll see that in 2013, even though there was another 21% growth that year, we were still only at 624,000 units, which relative to where we were in 2005 was, pretty anemic. And also, I will say that that since we believe that the sort of normal rate for single family should be maybe as high as 1 million, certainly not where it was during 2005 at 1.6. 624,000 was, relatively speaking, in context, not a particularly good year, but certainly better than where we were in 2008 and 9 and 11. Talking about the two standard measures of construction activity in the U.S., it basically comes down to two ways that you can access information for construction activity. The U.S. Census construction value put in place, also known as construction spending, is one source of activity, and the Dodge Data and Analytics construction starts is the other. The federal government, mainly through the U.S. Census Department, tracks overall economic activity so it understands how the economy is performing and as a result may enact appropriate policy-making decisions. Companies also rely on this government-generated data to evaluate business conditions and react accordingly. Here's a visual in terms of the difference between the construction value put in place, which is a coincident indicator. And that's because it records construction spending as it occurs. So, for example, if a $40 million office building starts construction in January, then the census records each month how much of that $40 million has actually been spent until construction is complete. Dodge Data and Analytics construction starts is a leading indicator. This is because Dodge Data and Analytics, using the same 40 million office project, records the entire 40 million in the month of January when the project starts. Therefore, construction starts indicates what will be spent, while construction value put in place indicates what has been spent. The Census Department's construction value put in place suffices to measure the overall health of construction in the U.S. economy. It presents a good general gauge for the industry. But if you want to gauge in advance the direction and change in your specific market opportunity. For most building product manufacturers, you want to use the Dodge Data and Analytics construction starts data. Again, this data is a leading indicator of forthcoming construction spend and is compiled from the individual Dodge reports and provides a more granular level of information. Whether you sell nationally, regionally, or locally, you can use this starts data to help you plan how best to deploy your sales, marketing, product, and other scarce resources. How do you refine your market opportunity? You can do this by tracking the movement of construction starts for those sectors creating demand for your products and or services specifically. While historical and forecast changes in construction starts for the combination of these sectors, creating opportunity for you, is often a very good proxy for understanding your market opportunity, you can fine-tune your market opportunity by applying 4 additional refinements. The first would be what we call lags. Okay? And that is the time and months between when market opportunity for your product is realized versus when a project's construction starts occur. This visual graph is actually information for total non-residential buildings taken from information collected by the U.S. Census Department, where they actually, by value of project, have determined how long it takes for that project's total spend to occur. So you can see, if you look at the lowest line on this graph, that for the larger projects, it takes longer for the construction spend to occur, which, quite honestly, is how one would expect it to occur. But you can apply these lags to the construction starts to fine-tune your market opportunity. The second way you can do that is you can apply what we call usage weights. And these are really just a way to, relative to each of the sectors that create market opportunity for you, to rank them or weight them in terms of the amount of expected market opportunity for your product and or service. So I've got an example here, and basically it shows that in this particular instance that for healthcare, right, for this hypothetical, let's call it building product manufacturer, right, the usage weight is 10, which means that relative to warehouse and to office building, the market opportunity for their products is 10 times greater than it would be for warehouses and twice as great as it would be for office buildings. Another way you can do it, and this is just going an additional step, is to apply what we call a usage factor. And a usage factor is more than just a relative ranking. It's where you actually look at plans and specifications and do a takeoff to determine what amount of market opportunity exists for your specific product for different types of sectors. Again, as an example, the amount of activity for your product that is generated from, let's say, a warehouse project versus a hospital. So this is a fine-tuning of the weighting system where you're just ranking. Okay? I know of clients who have actually also used their internal records to come up with a usage factor. So with the advent of a CRM like a Salesforce.com or whatever, there are clients that we have worked with where they can extract information in terms of what they bid on individual projects by type of building, and then we create a usage factor for them, and then take that factor and apply it against the construction starts activity by sector. Another way that you can refine your assessment of market opportunity is to look at the existing building stock. So very often people are looking at either the Commerce construction spending data or the Dodge starts data, which does cover new projects, major additions, and alterations, but I'll stress major additions and alterations. But there's a lot of activity and market opportunity that's generated from the existing building stock. Okay? And this is replacing existing products, like roofing as a perfect example. I know that depending upon how active new construction is, that the market opportunity for commercial roofing can be as high as 80% from re-roofing the existing stock. All right. The visual here is of 4 cities, 2 cities that are a little bit older, Boston and Chicago, and 2 cities that are newer. So one of the things you can do is, in addition to getting the absolute size of the building stock by geography, you can also look at the age of that stock. And I don't have the specifics, but I can tell you that if you looked at activity for Boston and Chicago over the past 10 years, that contributes to the 250 billion square feet of office stock in Boston and the 477 billion square feet in Chicago. The amount of that total that was contributed over the last 10 years is significantly less than the amount that was contributed over the last 10 years for the Dallas and Phoenix markets. And that's something that you need to consider. In terms of measuring change, if you look at construction starts activity, it is by its nature a much more volatile series with a much greater degree of change over time, year to year, geography to geography, than the existing stock. But when you're looking at the existing stock, sometimes what you do is you need to measure the change in the market opportunity that's coming from the existing stock based on some other factors. Age is one, but also some more what I would term general economic factors that help you understand the relative health of that particular sector. For instance, for K-12 schools, it could be the passage of local bond initiatives. For hotels, it could be the change in revenues per available room. And for offices, it could be the change in vacancy rates. So before I move on to the questions, I really want to recap what we reviewed about measuring market opportunity. First, we talked about understanding the change in total construction starts or spending is simply not good enough. At a minimum, one needs to drill down by the three broad categories of non-residential, residential, and non-building. Better yet, you should really peel back the onion, so to speak, and look at construction activity by individual sectors. For example, healthcare versus education. Not all sectors are equal in terms of generating market opportunity. If you are selling acoustical ceiling tiles, what's happening in the office sector is much, much more important and relevant to your market opportunity than what's happening in the commercial warehouse sector. Construction activity at the national level is often not reflective of what's occurring at the regional or local level. To assess or gauge how well your distributors, independent reps, direct sales, or business development people are performing against their market opportunity, one needs to drill down and look at construction starts or spending at lower levels of geographic disaggregation. Put numbers into context. Knowing that construction starts are expected to increase next year is good, but simply not good enough. Having an historical time series of what's driving your market opportunity is important. Remember the example of single-family units being up 25% in 2012 and another 21% in 2013, but still at a somewhat anemic level of 624,000 units in 2013. There are two standard measures of construction activity to help one measure their market opportunity. Construction spending from the U.S. Census and construction starts from Dodge. The former being a coincident indicator and the latter a leading indicator. Refining your market opportunity can be accomplished by applying lags and usage weights or use factors, and also by assessing the replacement, maintenance, and repair market opportunity derived from the existing stock of buildings. Thank you all so much for allowing me to talk about the process of how to measure your market opportunity for business success. I hope you found this informative and of value.